Over the last two episodes, we discussed something that many traders find uncomfortable, that trading success is not mainly about strategy. And we also saw how the mathematics of drawdowns can quietly destroy trading capital. But this raises a deeper question. If strategies are widely available, if information is easily accessible, if traders are intelligent and hardworking, why do so many trading journeys still fail? Why do people who understands market still struggle to remain consistently profitable? After many years of observing traders, I have noticed that the problem is rarely intelligence. The problem is structure and behavior. Most traders believe that once they find a good strategy, success will follow naturally. So they keep searching a new indicator, new pattern, a new option strategy. For a while, the strategy might even work, but sooner or later, something changes. Markets shift, volatility changes, or a losing streak appears, and suddenly the trader begins doubting the system. Then the search begins again. A new strategy replaces the old one, and this cycle quietly repeats itself for years. The real problem is not the strategy. The real problem is how trader interacts with the strategy. Because trading success is not about only knowledge. It's about behavior under uncertainty. See, markets are uncertain by nature. Even the best analysis will sometimes be wrong. So the question is not whether the losses will occur or not. Losses are inevitable. The real question is how a trader responds when the uncertainty appears. So in the most cases, three behaviors begin to appear. First, traders increase their position size when they feel confident. Second, they hesitate to accept losses when they go wrong. And third, they begin forcing trades when the results slow down. Individually, these actions may look small, but together they slowly damage the trading structure. See, over time, the accounts become unstable, confidence disappears, and the trader begins to believe that the strategy itself was the problem. But often the real issue was behavioral discipline. Professional traders understand something very important. They know that the uncertainty cannot be eliminated, it can only be managed. So instead of chasing certainty, professionals design a process that can operate even when the market behaves unpredictably. They control how much capital is exposed, they accept small losses very quickly, they avoid forcing trades during the difficult periods, and they understand that the trading is not a sequence of isolated decisions, it is a long series of decisions over time. One of the biggest mindset shifts in the professional trading is learning to think in probabilities. A single trade does not define success. Even a good trade can lose, or even a poor trade can sometimes make money. So, professionals do not judge themselves based on a single outcome. Instead, they focus on maintaining a consistent process over across many trades. Over time, this discipline process allows probabilities to work in their favor. Another important difference is patience. Many traders expect markets to produce income regularly, but markets move in cycles. Some periods offer opportunities, others require patience. Professionals respect these cycles. They protect their capital during difficult phases and become active when conditions improve. This patience allows them to remain in the game for many years. And in trading, survival is extremely valuable because the longer a trader survives, the more opportunities eventually appear. So, when we step back and look at the trading from a distance, an interesting pattern becomes visible. Many traders spend their time trying to improve predictions, but professional traders spend their time to improve decision structure. Prediction is uncertain, structure can be designed, and over long periods of time, structure usually matters much more than the individual predictions. Trading is often presented as a search for a perfect strategy. I will repeat again here carefully. Trading is often presented as a search for perfect strategy, but in reality, long-term success in markets come from something much simpler but much harder. It comes from discipline, patience, and controlled decision making under uncertainty. The trader who survives are not necessarily the smartest. They are the ones who build a process they can follow consistently. Because in the end, trading is not a battle against the market, it is mostly a battle against our own behavior. Thank you for watching this series. In future videos, we will continue exploring different aspects of professional trading thinking, risk behavior, and market structure. Because understanding markets is important, but understanding how we behave inside markets is even more important.